Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions, and he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to rollingcrash.com for your free copy of this new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show here on Stansberry Research. Well, with the debt ceiling drama behind us, can we all breathe a sigh of relief or not yet? Here to talk about this and so much more is Lynette Zang. She is the Chief Market Analyst over at ITM Trading. Lynette, always nice to have you on the show. Welcome back.
Well, thank you, Danielle. It's always great to be with you.
Yes.
You always ask such good questions.
Well, thank you. And you always have such incredible insight. So obviously want to get your thoughts on the debt ceiling. I mean, everyone stopped talking about it now because it seems like it's in the past. But the newly enacted debt ceiling law all but assures really that the winner of the 2024 presidential election and the next Congress will face another potentially disastrous default deadline soon after taking office. And I watched your recent YouTube video explainer on this, where you say, look, they just kick the can down the road again. So how will this come back to haunt us, Lynette?
Well, there are so many different ways that it can come back to haunt us. Number one, think back to when we played with the debt ceiling in 2011, and then we got a credit downgrade, which if you have lower credit, then that means that you have to pay more interest on a global level. But the difference between 2011 and 2023 is the level that the global central banks and the global countries have with the U.S. and how close we came to a debt default, even with some in Congress saying, well, maybe we should have a debt default. So, it's really precarious because treasury bonds are the foundation of the global financial system. And we're playing with the validity of those treasury bonds and sucking the liquidity, the ability to easily buy and sell them without big price dislocations. We're now about to suck even more liquidity out of the treasury bond market. I don't think this is over yet.
Exactly. It's such a valid point. And if you can help explain, if we're going to have a lot more treasuries in the system, what does that do to the system? How does it affect us?
Right. That's a great question. And people don't really know this, but somebody has to buy those treasuries. So you have the Federal Reserve that has been buying those treasuries now running off their balance sheet. So not only are they presumably, at least at this point, not buying any more treasuries, but they're actually selling treasuries into an already saturated market. So then the question is, well, who's going to buy all of these treasuries? And quite honestly, historically, and my bet would be right now, institutional investors that invests the public's money in pensions, in 401ks, in other retirement and other mutual funds, that they're going to have to be the ones to absorb it if we don't have the Federal Reserve absorbing it. And they've been absorbing the excess since the end of 2002. Right. So, but just since 2008 in a very big way.
Now we're speaking ahead of the much anticipated Fed meeting in July. Do you think this changes the course of action at all for them?
It certainly could. Because, they still talk about fighting inflation, right. But, a quarter point, they're running out of steam in that way. And while they've been between a rock and a hard place for a long time now, if there is indeed a crisis that comes up in the Treasury market, are they going to have to reverse course like they recently did during the community bank crisis, which also is not over yet?
I'm so happy you brought up that point because I want to pivot to fresh remarks from Treasury Secretary Janet Yellen, who, as you remember, Lynette, not too long ago was saying, don't worry about the banking crisis. Well, now she's saying she wouldn't be surprised to see more bank consolidation. She said it's likely for some smaller banks to consolidate, basically, is how she summed it up. Thoughts on her pivot? And I hate to use the word pivot, but that's exactly what it is.
Well, she does that too. It wasn't that long ago where she said she doesn't think she'll see another financial crisis in her lifetime. And, we have and we will, because this is not over yet. But I think it's an attempt to prepare us, because the problem with those other banks, there were a lot of problems, but a key problem is the raising interest rates and the lower market valuation on the bonds that are held by all of these banks. And I don't care whether you're a community bank or you're a JP Morgan. This is going to be true for everybody because they've been loading up on treasuries at basically zero interest rates since 2008. Okay, well, you can put them on your books. There's all sorts of funny accounting tools that can be used to hide the problem or make it seem like it's not that big. But I think Janet Yellen realizes that they can't hide this forever. So she wants to maybe be on record as saying, oh, okay, right. There are going to be more banks that fail. But I told you there were going to be more banks that fail.
Right. That makes a lot of sense. And I think the other part that probably got less press attention that I find interesting, and it's something that Gerald Celente, I know you're a good friend, brought up, and I just did a great interview with him. But she says she expects there to be issues in the commercial real estate sector given the changing approach to work. Issues, Lynette. How big is this issue?
Well, it's really interesting because just recently, what was it? Park Hotels gave back 2 big hotels in San Francisco.
Yes.
Because of this issue, right? So I went in to see, who's holding the mortgage on those, and it was opaque. So it's like a domino effect. Yeah. If they have non-recourse loans, which apparently these 2 loans were non-recourse, so basically what that means is they can't go in and attach other assets to pay these debts. That means that those banks, and by the way, all of those mortgages, all of our mortgages that were put in that lower interest rate environment have also lost value, right? Any debt instruments that were put in the lower rate environment and we're now in a higher rate environment has all lost value. So whether it's any kind of real estate, quite honestly, but in the commercial sector, that's been hit a lot harder. And we're going to see a ripple effect as these corporations give up the real estate to the banks. Who are they going to sell them to? And at what price?
Exactly. And like Gerald says, you can't just convert it for it to become residential.
Right.
So.
Right. And multi-use. This takes a lot more money and a lot more time into a contracting availability of credit.
Yep. And this always gets back to your main thesis, anyone who follows your work, Lynette, that you say and have been saying it's just one big distraction. So kicking the can down the road for the debt ceiling, the banking crisis. But the question is always, what are they trying to distract us away from?
The next big crisis, which, who knows when we're going to see that. But the reality is this is the end of the current system's life cycle. And it actually died in 2008.
That's
and
right.
They just pumped a whole bunch of, garbage into the system to make it look like it's still alive and still viable when it's not. Did you look at Zimbabwe, right?
Yep.
Zimbabwe's stock market is up 600% because people are trying to save themselves for the depreciation in the currency because the public gets it. And they've been dealing with it for a very long time. But is the stock market really going to save anybody? No, because the only thing you can convert your stocks into is this garbage that they're devaluing. And that's the only choice that they have. And officially, we have 3 cents left. And if you go on the Fed, you just see that continue to decline. So that's official. When we get to zero, is that because the public has lost confidence in this currency, in this con game, is absolutely over?
And that brings me to my next point, because you've been very vocal and transparent about your views on the crypto industry. And I want to get your thoughts on the SEC's crackdown, throwing a 1-2 punch this week to Coinbase, to CZ's Binance. The bigger question I have for you, Lynette, is what you make of the timing of this. Their FedNow system is coming out, and a lot of experts think that they're just trying to destroy the competition. Do you think that makes sense? Yeah?
Oh, makes perfect sense. In fact, it was either the IMF or the BIS, Bank for International Settlements or International Monetary Fund, their paper that basically was private crypto's bad. Federal Reserve, a central bank crypto's good. So, they brought it out. It got in 2009 was when Bitcoin came out. So it was about getting people comfortable. Now we have, as you pointed out, the FedNow accounts going into effect in July, so very shortly. What we need is a ginormous crisis that scares the crap out of everybody, that they then pump a whole bunch of these CBDCs in and say, go spending, right? Because we're a consumer-driven economy.
Yeah.
Here's a whole bunch of free money, right?
You say bigger
and they're
crisis.
attempting to get adoption.
I'm saying bigger crisis than what we just went through with the pandemic.
Yes. I think that was a test to see how far they could push people and what they could get people to do. But bigger than that. It has to be. We need to change the entire system. And things don't look the same today as they did before, just like they don't look the same as they did in 2007 before the banking system actually died. So, much bigger.
Bring it home for us with this. Just your thoughts on what, the lack of action we're seeing in the gold price. Now, anyone who invests in gold really should not be tracking the price of gold daily, but I get the emails of why isn't gold higher, despite everything going on. Lynette, what's your take on what's happening here on the gold front?
It's truly so simple. Number one, what is currently happening in the markets is that the biggest debt bubble in history is in the process of popping. And the central banks are being integral in popping that massive bubble. While a rising gold price is an indication of a failing currency. And once you really understand that this stuff is going away, then you go to this stuff. But if you go to gold, it's outside of the system. And it holds no geopolitical risk and no counterparty risk. It is a proven inflation hedge. So do they want you to hold this? No, they don't. Why would they want you to do that? They can't just take it then.
And it's interesting, though, because we see central banks continuing to buy gold. In fact, World Gold Council just put out a survey that, surveying most central banks, saying they have no intention of slowing down their gold purchases, trying to pull an add in. But everyone will focus and say, "Oh, but Turkey sold their gold." I know you speak about this.
Right, because, what is gold's function? Gold is savings. That's what it is. It's protection. What's Turkey going through right now? They need a lot of protection. So gold in Turkey, they're not selling it because they feel, they don't need it anymore. They're selling it so that they have access to the things that they need because nobody will take the Turkish currency.
Exactly. Well said,
It's
Lynette.
doing its job.
It's doing its job. Lynette Zang, thank you so much for joining us today. Always appreciate your insights. Crazy stuff happening here.
Absolutely, and I'm so happy to be here, Danielle. It's good to see you.
Good to see you as well. And be sure to stay tuned for more great content coming your way on the Daniela Cambone Show here at Stansberry Research. And don't forget to sign up to be alerted of all this great talks at danielacambone.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.